So in the first video you already saw, I talked a lot about different kind of indicators, but in this presentation I want to talk about another kind of indicator which is called volume and price analysis, or VPA. So this one is, in my opinion, is the most powerful and most important indicator to understand, because it's going to tell you a lot about the price action. And what I really like about this one is that it tells you some insights before the move is going to happen. So like many indicators we saw in the first video, like the VWAP, the moving averages, it's all what we call lagging indicators. So it's showing you information after the movement have already happened. So it's late in terms of the info it's giving you. But with the VPA, the great thing is, like I say, it's going to give you insight before the move happened, where you can actually predict the future. Again, it's never 100%, but it's giving you some really, really powerful insight. And this whole presentation, this whole video, is going to be about VPA. So we're going to jump into volume and price analysis. We're going to break it down together. I'm going to talk about the difference between confirmation and divergence, which those two are the two main categories with VPA. Then we're going to see some candlestick patterns in terms of VPA. So analyzing some candlestick match with the volume, what kind of insights it's giving us. And lastly, we're going to finish this video with a chart example where we're going to read the price and volume together. So VPA, volume and price analysis, what do I mean by that? So it's basically a method used in day trading to analyze the relationship in between the price and the trading volume. What I mean by volume, if you're new to trading and you have no idea what I mean, on a chart, it's basically what you see on the bottom part here. So each volume bar is mixed with one candlestick. So during that minute, let's say like we can see here is a 1 minute chart. So during that first minute here, it's matched with this volume here. So it's all the transaction that happened during that specific minute. So it's the number of shares traded during a specific period. It's really important because this volume is indicating you the level of interest in a particular stock. So when you see a really high volume, so a big volume bar, let's say like this one here or this one here, it's telling you that there's a strong investor interest. While when you see low volume, it's the opposite, is a lack of interest. So if we see like this one here or this one here, it's telling us that there's a lack of interest, and there's not a lot of buying, not a lot of selling. It's just resulting in low volume in general. Then we have the price, which, like we saw in the first presentation, it's basically the candlestick. Well, that's the way we analyze it on the chart, using candlestick. So it's the current market value of a stock or asset being traded. It's important because price movements provides you information about market sentiment and trends, again, like we saw in the first presentation. But where it gets really, really interesting in terms of VPA is when you match those two information together, because together, this is giving you a lot of information, and you can actually predict what's going to happen by reading those two at the same time. And we're going to see it together through the two main categories. The first category of VPA is called confirmation. So confirmation happens when you have a high volume mixed with a significant price movement, either up or down. So it often confirms the strength of that movement. For example, a price increase with a high volume suggests a strong buying interest. So if we look at the two examples I put here. So the first one, we see the candlestick making a pretty decent move. So what we can call a big move here. We see the candles with a wide spread in between the open price and the closing price. And this is mixed with above average volume. So this is what we call confirmation. So a big movement in terms of candlestick, in terms of price movement, should always in theory be mixed with a lot of volume, because if the price moves a lot, that means there should have a lot of buying supporting that move. And we have a second example here where you see a small spread, so a small price movement with lower than average volume. So again, here's a confirmation because it makes sense. If the price is not moving too much, well, it shouldn't have a lot of volume mixed with it. So that's confirmation. And on your chart, you will, in most platforms, I'm not sure in all of them, but I know in Dash Trader, the one I use, you can have a line with the volume, which is the average volume. So you can see if the price, if the volume is either above average or below average. And with that, you can mix it with the candlestick and know if it's a confirmation. Then the second category is divergence, and divergence basically is the opposite. So it's when volume does not support the price movement. It can signal a potential reversal. At the end of this course, this masterclass you're doing, I will have a video talking about reversal, and we're gonna see together how important seeing that kind of divergence is in my strategy of reversal. So, for example, if the price is rising but the volume is decreasing, it might indicate that the upward trend is losing momentum. Really, really powerful indicator reading the divergence. And you see divergence on let's say a 1 minute chart every single day. It happened all the time. So, two kind of divergence here. Either you see a big price movement, so widespread, mixed with lower than average volume. So here, there's something that doesn't make sense. It's what we call an anomaly. So if you have a big price movement, well, you should have a lot of volume, at least above average, to make sense. But sometimes you will see really, really low volume with a big price movement. That means that there's some manipulation. Most often than not, is the market makers that are manipulating the price action to fill some orders, but the volume is not coming. So that's it. That is usually a red flag. And if you see that in the uptrend, that could mean that it's a sign of reversal. Doesn't mean it's going to happen 100%, but the probability that it will happen are in your side. This one, you see it, but not as often as the second example here. This one, you see it really often, and is one of the signal I like the most for my reversal. So it's when you see a small spread, so a small price movement with above average volume. Basically, when you see this match together, the story is telling you is that the buyers and the sellers were fighting here. Nobody really won because the candlestick ended up making just a small movement. But during that 1 minute, it was a big, big fight with a lot of buyers and a lot of sellers coming in. And you can see it with the volume. If the volume is really high above average, it's telling you that there's a lot of interest. But no movement is happening. So that's a red flag. So if you see that kind of things in the uptrend like that, it's usually a sign that the price might reverse really soon. So this one is one that I see really often and I pay really close attention to. So this was basically the two main category. Pretty straightforward. We have divergence, we have confirmation, both are opposite, and you can read it with those two examples here that you see really often. Now, let's talk about those two categories again. So confirmation and divergence, but how they look like when you mix a couple of candlesticks together. So when you have multiple candles, how you can read it. So the first one, confirmation. So if you see a bullish uptrend, so the price going up and the volume is also creeping higher, well, that's a bullish uptrend. It makes sense, right? It's a confirmation. If the price goes up, the volume should go up as well. Same thing, same situation on a bearish downtrend. So if you see the price going lower and the volume increasing, that means that there's a lot more sellers coming in, which result in the price going down. So that makes sense. So if you see that kind of pattern going down with volume increasing, here, there's nothing that tells you that you should go long. It's like trying to catch a falling knife here. You have no red flag that the price will be returning or reversing anytime soon. So here, if you play reversals, you want to stay away. But if you play some kind of continuation strategies, well, you can expect that the price will continue to bleed lower in that case because the volume is mixing with the price action. Where it gets interesting is when you have divergence. So when you see, for example, the price going down, but the volume is decreasing, this is a bullish reversal. This is what we call an exhaustion. So the story that those three candlesticks are telling me is that, okay, the sellers are bringing the price down, but they're starting to lack momentum because I see it with the volume. So there's still sellers coming, but there's less and less and less and less sellers coming. So I have a pretty good insight that at some point there will be not enough sellers and the buyers will outstep the sellers and start reversing the price. So if I'm playing reversal and this is one of, let's say this is a support line, I'm really interested in going long. I see the price going to that line, and while the price is going to that line, the sellers are losing momentum. They're getting exhausted here. Well, I can play the trade to the long side here and go with a buy. So this is a kind of VPA I like to see at some important levels. Same thing if the price is going up. So if I see the buyers pushing the price higher, but they're starting to lack momentum here. They're starting to get exhausted. Well, this is a bearish reversal sign, so I can expect that at some point they will lose all their momentum, and it's just a question of time before the sellers take control and bring the price lower. So this is how confirmation and divergence look with a mix of candlestick. For example, the way, if you already watched my video, my free video on the opening range break and retest, this is the kind of thing I like to see. So if I have, for example, the first 1 minute closing something like this, I have the opening range, I see the price breaking outside of the opening range with 3 candles. That's exactly what I want to see. Then I want to see a retest of that opening range. So if I see the retest with 3 candlestick going higher and the volume decreasing here, I'm really excited to go short here because I know the probability are on my side to start making another leg down. So that's how you will read a divergence, mix of candlestick representing divergence in my opening range break and retest strategy. All right, now let's talk about some specific candlestick pattern that you will see every single day. The first one that if you've been trading for a while, you already know how it looks like, a shooting star. There's different kind of name. You can call it a reverse hammer candle, but that's basically how the candlestick will look. So if you play reversal, that's a kind of candlestick that is really tempting. So let's say you have an uptrend and you see that kind of candle in the top of an uptrend, right at the level you're interested in going short, you will be really tempted to take the trade to the short side right here. But a lot of traders forget to watch one super important information with that candle, which is the volume. So you cannot read VPA without the volume. You need the volume and the price to have the whole story together. So if you see that kind of candlestick in the top of an uptrend, but with lower than average volume, what is that telling us? Well, it's telling us that it's a confirmation. This is not a divergence because the price movement is basically the body of the candle. So we see a candle that opened here, closed here. So a small price movement. With a small price movement, we have a lower than average volume, which makes sense. So that's a confirmation. So this candlestick here matched with this volume is not a red flag. It's completely normal. But with that same exact candlestick here, if we have above average volume, that's telling us a whole completely different story. It's telling us that the buyers pushed the price here, the sellers stepped in really heavy, was a big fight, but the sellers won that fight because they were able to push the price and close it really, really close to where it opened. Because we see high volume here. So this is turning in from confirmation here into divergence here because we have a small price movement with above average volume. So that will be a really interesting candle if it's right at a level where we're interested to going short on the top of our uptrend. Is the exact same story on the hammer candle, just on the opposite side of a trend. So let's say you want to go long, you see the price going down, down, down. That's a level you're interested in going long. You see that kind of candle forming with low volume, don't go long just yet. What you need to see is that kind of volume mix with that same kind of candlestick, same kind of pattern. There you will be really interested in going long. So you need to see an anomaly, not a confirmation in that case. With the doji here, doji candle is a really popular candle that you see really, really often, is the same kind of theory that is applying here. So if you see a doji in the top of an uptrend with lower than average volume, so it's a small price movement mixed with low volume, you have confirmation, is no red flag that the trend is necessarily going to change here. But when you have really high volume, it's telling you that there was a big fight happening in between the buyers and the sellers during in between that range here. Nobody really won because the price closed pretty much where it opened, and you see a lot of volume. So a lot of buyers were coming, a lot of sellers were coming, and you see that in the top of uptrend where here you can be really interested in going short. So same kind of story. We can see those same candlestick in a mix of candlesticks. So this is 3 candlestick pattern that we call an evening star. Same thing here, but on the downside, which is called a morning star. So you see the price, let's say, going up. You see the candle in the middle here. So the big fight in between buyers and sellers with high volume, really important to be above average. There, it's a sign that the price might reverse. So in that situation, let's say you were having an important level here that act as resistance. Maybe you can go short on the 1 minute low here as a second confirmation. Same kind of thing on a morning star. If you have, let's say, an important daily level here, you see the price going down to that level, you see a big fight going on with high volume. In the next candlestick, if you see the buyers starting to win the fight, you can enter long right here with a buy. So that's how I will read the volume with those candlestick patterns. In this slide here, I have a really interesting example that I want to see with you. So we're going to read the price and the volume on that chart and try to understand the story that the price action is doing here. So first, I'm going to block the volume we have here, and I want you to just pay attention to the chart. So I want you to pay attention to just the candlestick and what is the first thing that came into your mind. Is that bullish price action? Is that bearish price action? Is that just consolidation? What do you think here? So for me, just by looking at the candlestick, this is a clear uptrend. So we see the price just moving up and up and up, and I see strength. Now let's read it, mix with the volume, and see if the same story is applying here. So the first thing we see is 3 candlesticks here going up. While those 3 candlesticks are going up, we also see the volume going up. So like we saw, this is confirmation. So this is strength. So here, there's no sign that the price will start reversing lower. It's just a sign of strength. And I can guess that the price will just keep rising higher. Then we have our first red candlestick right here. If we read the volume on that red candlestick here, we can see that this is pretty, well, not lower than average, but it's kind of consider a lower kind of volume because it's lower than the 3 white candlestick we had here. So we see a pullback, not a reversal here. It's just a sign that some people that were long start taking profit, but there's not too much people worry about the price reversing lower. So here's still no sign to go short. And it's even maybe a place where some buyers, some continuation setup traders that will jump long for another leg up. Here we actually have our next leg up. So we have 3 more candlesticks going higher, but there it gets interesting because while those 3 candlesticks are going higher, while the price is moving higher, we see the volume slowly decreasing here. So here we have our first anomaly, our first divergence, because when the price go up, well, the volume should also increase with the price. So here, first red flag. Then the next candlestick after that, we have the reverse hammer that we saw on the previous slide. And with that reverse hammer, we remember that we need to see a lot of volume to be it considered as an anomaly, as a divergence. And in that case, yeah, the volume is really high here, above average. So this is our second anomaly here. So 2 anomalies here in a row. So let's say we were having an important level here where we're interested in going short, so a level of resistance. On the next minute, when I saw a 1-minute low forming here, I will have definitely jumped to the short side because we have some volume indication. We're at the right spot. So I will have jumped short. In that case, I will have put my stop loss here and take the loss. And that's why I love this example, because it's showing you that it's giving you insight of what's going to happen, but it's never 100%. Everything with the market is never sure 100%, and that's just how the game is. But let's keep reading the price here. What's going to happen next? So after this really nice reverse hammer candle with high volume, our second anomaly, we see the price making another leg up with 3 candlesticks in a row. And again, we see the price decrease in volume. So this is our third anomaly here. So we have 3 anomalies here in a row, telling us that the buyers are really getting exhausted here, and it's just a question of time before the sellers step in and they will flush the price lower pretty quickly. So by just reading at the candlestick in the beginning, we saw a clear uptrend, but with reading it with the volume here, it's a completely different story here. We see the price going up, but while I see the price going up, I see a lot of weakness. So before the reversal will happen, I'm starting to see it happening. I don't know if that makes sense, but that's what I mean about predicting the price action. So really interesting example here, seeing you two kind of different stories when you look at it just by the candlestick and when you mix the volume with it. Now let's see some example on real trades that I took using my opening range, break and retest strategy. If you haven't watched the video yet, I really consider and recommend you to go watch it, and you're going to be able to implement what we learned with VPA with that strategy, hopefully a lot clearer after this presentation. So if I do a little quickly recap of my strategy in 3 steps, basically first step, you want to mark the opening range, so the distance in between the high and the low of the first 1 minute candle, which is the green box on the chart here. After that, you want to see 3 candlesticks in a row closing outside of the range, 1, 2, 3. So this is a valid breakout, and then you want to see the price pull back, retest that opening range with anomaly. So either a decreased volume or lower than average volume to tell you that the price is just preparing for another leg down. So I want that confirmation that this is not a reversal. This is just a healthy pullback before preparing to pick another move in my direction. So in that case, we had 2 white candlesticks going to retest the VWAP and the opening range. And I saw the volume really low here, below the average line, and also decreasing slightly. So here everything was in line for me to take the trade, and that's what I did, jump to the short side, and I catch the move lower. If we keep reading the volume a little bit, every time we had a nice leg down, we saw the volume increase, which is a really good sign. So here there's 2 spots where I would have maybe be a little less confident in the trade. Will be first one right here, when we saw a candle picking up some volume and a small price movement. So this is an anomaly. So here the price could have reversed and stopped me out at break. That was a bad line. I'd break even right here. Sorry about that. So again, it's never 100%. In that case, I got lucky. The price didn't reverse on me, but it kept moving lower. And while it was picking up more downside here, the volume was above average, so really nice. The kind of candlestick that makes me more confident is that one here. So we saw the price pull back a little bit lower here, but a little bit higher here, I mean, with lower volume. That's really good. I was just after that expecting another leg down, which is exactly what happened right here with pretty nice volume. Where we had another anomaly is this candlestick right here. So that's way too much volume for the kind of price movement. If we compare this candle here, so the movement is basically this distance here. This distance here is pretty much the same as this one here. So similar distance, but if we compare the volume of that candle here versus this one here, this one is what, like 3 times more than this one. So technically with 3 times more volume, I should have seen 3 times more that distance here. So the candle should have looked more something like this to the downside, which didn't happen here. So this is a kind of anomaly here. And I have no idea what happened right there after taking the screenshot, but I wouldn't be surprised if the price start reversing back to the VWAP. So basically how you read volume with the AMD example here. Let's see another one on RGTI. So same exact strategy. We mark the opening range, so the distance in between the high and the low of the first 1 minute candle. Then you want to see a breakout with 3 candlesticks in a row. So we have 1 here, 2 here, 3 here, valid breakout. The last step, you want to see the price pull back, retest the opening range before moving higher. But you want to see the price with either on the average or hopefully below average for more confidence. In that case, we saw the price starting to pull back right here with lower than average volume, so that's good. Where the trade got no good and I decided not to enter that one is with that specific candlestick here. So we saw a big red candlestick with sellers stepping in with a lot of volume here, above average volume. So that's a red flag. That's or a red flag to not enter the trade, because that's just telling me that the sellers are having a lot of momentum here and the buyers won't have enough power to bring the price back higher. So it's just gonna take the opening range and move lower, which is exactly what happen after that. If we look at the candles, the volume bar after that, pretty much all the red volume bars are higher than the white ones. Just an easy way to tell you that the sellers are in control here, and there's no sign of you for you to go long in that situation. So that's basically how I read the price action, so the volume and price analysis. So really, really powerful tool. Is something that is a little abstract. It's not like reading the VWAP or a moving average. It's something that requires more practice. You need to see more charts, but with experience, it's going to come clearer and clearer, like reading a book. And I hope this presentation on VPA was clear. And that's pretty much the way I read the volume. So by the way, this volume thing is something I apply in all of my strategies. So either I play opening range break and retest or reversal, I will always have the volume on my charts and analyze it. And another little important thing is that in this presentation, I talked a lot about the 1 minute chart, but those same concept you can apply to daily chart. So if you're a swing trader, reading the volume mixed with daily candles is really powerful too. Any kind of time frames, even weekly, it's going to be valid here. So that was the volume and price analysis presentation.